Trading the extended tap of a TCT model. There are going to be live trading situations where you will see me take a trade which is not at the original third tap of our TCT model, but rather the retest that come after the third tap already took place, which is something I like to refer to as the extended tap, which you could also name the fourth tap, or if the fourth tap was the retest and you're entering on the retest after the fourth tap already took place, that could also be considered the fifth tap. Therefore, the extended tap is kind of referring to the overall retest after being in a confirmed TCT model. Now, there can be multiple situations as to why I am not positioning myself on the third tap. And obviously, the most obvious reason is going to be that sometimes you simply miss the entry on the third tap due to unfortunate timing. However, there are also going to be situations where maybe the return to zone wasn't high probability enough coming towards that third tap market structure low, and therefore you were unsure if price was actually going to get any follow through after breaking structure back to bearish, and only after seeing the follow through with that high quality pullback creating new sell side liquidity, it allows you to draw an actual high quality, very visible liquidity curve, giving you more confidence in the model. And therefore, the better situation to put yourself in is to wait with the entry on the third tap to gain more confidence, build more conviction, and get the entry on the retest, which we can consider the extended tap. When we're focusing on a Model 2 schematic, if we are in a Model 2 distribution, the retest that happens after our third tap has already taken place is something Wyckoff refers to as our LPSY. When we're within a Model 2 accumulation schematic and we get that retest after confirming our Model 2, that is something Wyckoff likes to refer to as our second LPS. Going to the Wyckoff page right here, we can see that when we are in accumulation, you have your SC, ST, and Spring representing your tab 1, 2, and 3. In a Model 1, you also have that test, and then along the way of going up, you have these higher lows, which Wyckoff likes to refer to as an LPS. And when we go to the definition of an LPS, it represents our last point of support, the low point of a reaction or pullback after signs of strength. Backing up to an LPS means a pullback to support that was formerly resistance on diminished spread and volume. On some charts, there may be more than one LPS, despite the ostensibly singular precision of this term. And when we're focusing on a Model 2 schematic, you can see that the way that we are using Wyckoff, the original third tap is already going to be an LPS, and therefore if we're trading the extended tap, is going to be our second LPS right here, which you can see back right there in that schematic. When we are trading a fourth tap, it is extremely simple to understand because the requirements of a fourth tap are the exact same as the requirements of our third tap. So if we want to be trading the fourth tap, or in Wyckoff terms, LPSY, the pullback simply needs to sweep extreme liquidity or mitigate extreme supply of the expansion away from our original third tap. If price pulls back into extreme supply or sweeps extreme liquidity, that's when we can validate our fourth tap, and we simply enter up on a bearish breakout structure, confirming the rotation back down to the range low, where in this simple model, the usual high probability variables around TCT models apply, with our high probability ranging environment, our minimum range duration, our quality third tap POY, which in this case is going to be our quality fourth tap POY, and then obviously a quality breakup structure. So in this situation, we can imagine that maybe there was some demand in this region that you were simply skeptical about, and you didn't have that conviction entering on the third tap because you did not know what this demand in the discount section would deliver. In those situations, we're applying that abundance mindset, and we simply only want to be entering trades where we truly have that conviction behind our entries. So therefore, we're waiting for the mitigation of that tap, and we're going to observe, okay, what are the extreme points that price left behind in that expansion away from our third tap? And then if price manages to make its way back up to those extreme points, continuing with that high probability return to zone, we can trade the extended tap, which or at least I like to refer to as my fourth tap entry. And then Wyckoff terms is going to be your LPSY. And from an accumulation perspective, is the exact opposite, where maybe there was like a high quality supply POY in here that you were simply not sure about. You had an overall good return to zone, but the supply was there, which was the only kind of like obstacle within price rotating back up to that range high. You did not have that conviction in the third tap right there, so you're waiting for that supply to get mitigated, and you want to see that pullback, leaving buy side liquidity above, coming into again the extreme levels of that initial third tap expansion, and that's where you want to be trading the fourth tap, or in Wyckoff terms, the LPSY. Now, for the people that are paying very close attention, you might already notice that this looks extremely similar to our EHP, our extra high probability model, where basically you're coming into that POY, which already swept liquidity of the initial second tap expansion. The only difference between right here trading the extended tap versus calling this an EHP is that not in every situation can this be validated on the higher time frame as a regular Model 2. If on the higher time frame this is a regular Model 2, then you can also call this an EHP, where you have that lower time frame extended distribution in combination with the regular higher time frame distribution. But that is not always the case. You can't always validate this on the higher time frame as a normal Model 2. And sometimes you simply have an actual fourth tap, which is super normal because in Wyckoff, that's also explained, we call it an LPSY, and from an accumulation perspective, we call it an LPS. When we are focusing on a Model 2, we can only trade the fourth tap as our maximum extended model. If price later on comes back for the extreme supply and extreme liquidity of the expansion away from our fourth tap, basically creating a fifth tap, in most situations, I am not trading the fifth tap right here. I am only using the fifth tap as an opportunity to trill my stop loss to de-risk the position, which is something we'll dive into later within the execution section. But the reason for this is because if we're coming back for a fifth tap that again grabs the extremes, to me, that's showcasing a lack in selling pressure and a lack in follow through towards the downside. When you're having these extended models, typically the follow through from those models is going to be more significant because that fourth tap was an extra opportunity for the market makers to distribute price, to fill more shorts, to create more selling pressure. And the more selling pressure that's built up, the more aggressive the expansion towards the opposite direction can be. But when we're coming back for a fifth tap, it's simply becoming too extended, and it's just showcasing a lack in follow through towards the downside. While simultaneously, because we're coming back for a fifth tap, right now we also need to be aware that we're low-key creating a supply chain in this region. So because you're creating a supply chain, you're automatically also building buy-side liquidity above. And usually when I see a fifth tap and price isn't getting that follow through, it just ends up reversing to take all these highs out. Because each lower high is building more liquidity above that point. As long as we are in a Wyckoff model, those points should be protected. But if we're coming back for a fifth tap and we're spending time there, that slowly becomes a liquidity target as well. So within the Model 2, I'm never trading a fifth tap. I'm only using the fifth tap as an opportunity to trill the stop loss and de-risk the position, partially. And it's the exact same from an accumulation perspective. If price comes back again towards the extreme demand, that simply means you're respecting a demand chain coming up right here, where this demand creates that demand creates that demand right there. And it's just showcasing a lack in follow through towards the upside. So you need to be watching out for you not to be creating trend line sell side liquidity, where if price starts to range in here without getting that needed follow through, you can come for all that liquidity. When we're trading the extended tap in a Model 1 distribution or Model 1 accumulation, is going to be slightly different. Because you guys already understand the term Model 1s flowing over into Model 2s, which is explained in the Mentorship 2024 in the Advanced section, Advanced TCT Schematics, where I've elaborated on the fact that you can have your Model 1 distribution right here with your tab 1, with your tab 2, and with your tab 3 that can leave behind supply that price later on can come back for. Where you kind of have your Model 1 right there turning into a Model 2, creating, in that sense, an extended distribution model. If you have a Model 1 flowing over in a Model 2, that can create an extended distribution model. And from a tap perspective, you technically have 4 taps: a tab 1, a tab 2, a tab 3, and a tab 4. In the situations where you have your Model 1 flowing over in a Model 2, you can still look at a retracement into extreme supply from the Model 2 perspective. So we have our 1, we have our 2, and we have our 3. That's our Model 1 distribution. Price comes back for the extreme, and we could have our 4th tap, which is basically our Model 1 flowing over in a Model 2. From the Model 2 perspective, this is your 3rd tap. From a technical standpoint, if we're focusing on the Model 2 part of it, that's that Model 2 tap creation. That confirms it from a Model 2 perspective. You already have a Model 1 prior, but Model 1 into Model 2 is confirmed here. In these situations, you can still trade the retracement into the extreme supply after the expansion away from technically the 4th tap. And therefore, you can technically trade the 5th tap, because this is still a valid entry right there. Because you then basically have a Model 1 flowing over in an extended Model 2, where this is that first extended part. If price after this tap right here, which is technically speaking the 5th tap, comes back again, that's when we don't want to be trading the 6th tap anymore. Because you're just building a lot of buy-side liquidity above here that if price starts to range in here, can just come back for. And from an accumulation perspective, it is the opposite, but the same. Where you can have a Model 1 accumulation that flows over in a Model 2, and that Model 2 right here can still have its extended tap. Which technically, looking at the entire model, you're going to have your 1, you're going to have your 2, and you're going to have your 3. And then from a Model 2 perspective, this is technically the 4th, and this is the 5th. Okay? Where again, on these pullbacks coming into the 5th tap, we preferably want to see some sort of buy side or sell side liquidity getting created. It doesn't have to be your highest probability return to zone, but preferably you want to be able to either draw that liquidity curve in that market structure low in best case scenarios, or have that situation where the liquidity curve is split into 2 parts, where this part represents a lot of sell side liquidity, and then the final retracement here on the lower time frame also has liquidity. Maybe not from an obvious low perspective, but at least there is no demand in this area backing up the lows. And then from the accumulation perspective, preferably we can draw that return to zone from range high straight into that market structure high. But it could also be that this is simply going to be your return to zone, and it's going to be split into two parts, right here, and then in this last expansion towards the downside right there, on a lower time frame, there's also liquidity. Maybe not from an obvious higher or lower high perspective, but there's simply no supply that can protect price from coming towards that range high. So in the regular model 2, the maximum that we're trading is a fourth tap, which is represented with an LPSY or an LPS, the second LPS in Wyckoff terms. When we have a model 1 into a model 2, you can still get an extended tap, which is technically speaking the fifth tap. While all the other high probability variables remain the exact same. This is simply giving you re-entry opportunities if you have missed the original entry from the third tap, or it's giving you an actual entry opportunity because you did not have the conviction when the third tap was taking place and you simply wanted to see more. While lastly, it could also increase your RR on your original position. Because if you manage to catch an entry on the Model 2 distribution and price comes back for the LPSY, since that tap could be part of your Wyckoff model, the moment you break that structure back to bearish, you can trill your stop loss from the third tap high back down to the high of the LPS, because that should now be your protected high because it's part of your Wyckoff model. And because you are trailing your stop loss, you are minimizing your risk, and you can add that risk back on the bearish breakup structure, and you can increase your RR on the same trade idea. And the exact same applies from the accumulation perspective. So it has a lot of benefits. Either you miss the entry on the third tap and you get a re-entry opportunity, or you get just your normal entry because you didn't have the conviction behind your third tap, or it can even allow for higher RR entry opportunities while already being in the position and netting you more on the same trading idea.